Welcome to today's video. I'm Michael Neuenschwander with Outlook Wealth Advisors, I'm a CPA as well as certified financial planner. And in today's video, we're going to get a little bit more detailed on a couple of just investment categories that often cause some confusion, or simply letting people understand what's the universe, what's available out there. When we talk about fixed income or some safe investing, the common things that come to people's mind are CDs, bonds, annuities, both good and bad, which we'll touch on. But what are some of the other things that are also out there that many people simply aren't aware of? So the purpose of today's video, we are not talking specific investments, of course, but we want to talk about different categories of things that are available that may be appropriate for some people as they are near retirement or they're looking at things on the more conservative side of their investment spectrum. Obviously, CDs are fairly self-explanatory. This is guaranteed by the FDIC, typically getting from the bank, but you can also get those in your brokerage account, which many people are not aware of. So whether it be a Fidelity, a Schwab, even a Vanguard, most of the big firms offer what they call brokered CDs, which simply means they have arrangements with several banks. So instead of you having to go shop at several different banks, you can simply do it with that investment firm inside your existing account. Of course, bonds we can look at and say now you've stepped out of the guaranteed scenario. This is bonds are simply just a promise that you lend money to a company, they're going to pay you back. You can buy individual bonds, municipal bonds, you can buy obviously corporate bonds, and then all those variations in a bond fund. There are some key differences though. If you own a particular bond, you have a pretty good idea. Here's exactly what interest it's supposed to pay. Here's exactly what the maturity date or when you should get your principal back. Plus and minus of that bond is you get a little bit more clarity of to what's going on. The minus, of course, should that one entity not be able to pay you back, there's a little bit more risk in that individual bond scenario versus owning a bond fund. However, bond funds are not without their negatives as well. As many of us can remember back in 2022 when rates were really shooting up, almost all bond funds were actually negative, for the year. So as you have a fund that does not have a defined maturity date, that introduces a little bit more uncertainty, a little more volatility to that investment. You may have an average coupon or an average yield that the bonds inside it are paying, and you may have an average maturity date, but quite simply put, say bond funds will typically trade and move around more than simply an individual bond. Then we bring up that word that some people love, some people hate, but what about annuities? So those are frankly all over the place. We have a separate video where we've addressed the different types of annuities, but for today, let's simply look at what are called the fixed annuities. Fixed is the key word when you're looking for something safe or conservative from the annuity world. However, annuities, let's be clear, are backed up by the insurance company. They are not FDIC insured, so the ability for that to be guaranteed and get what you're supposed to get is riding on the financial standing of that company. So you want to make sure in looking at an annuity, if you've done some research, you understand how much reserves, how long has the company been around, etc. But the fixed annuity in one sense sounds somewhat like a CD, but said not FDIC insured, but the insurance company is guaranteeing a certain rate for a certain amount of time. Historically, fixed annuities do pay better than a CD. The trade-off is they're not FDIC insured. Over the past couple of decades, though, really the emergence has been what's called a fixed index annuity, where rather than the insurance company giving you a set rate of return, what they're really doing is they're going to link that return in some fashion to what the market, to what an index is doing. Typically with the certainty that you can't lose money when things go down, but you can earn some higher interest when things go up. There can be all different styles of fixed index annuities, some of which may only last a few years, some can be much more longer term commitments, some can offer a bonus, some offer guarantees of income, or like we touched on a video where we addressed long-term care, some offer additional benefits for long-term care as well. The key thing to understand with an annuity, they are a contract between you and that insurance company. So you want to make sure you have a pretty good understanding of what you're getting into, and there are good and bad. Many places might to try to point out the bad, simply saying it's long term. Sometimes they'll talk about high fees, or they'll talk and say, well, it's never going to do as well as the market. If your alternative is investing in the market and you're comfortable with that risk and ups and downs, then the real answer may be that a fixed index annuity isn't the right tool for you. But if you're comparing them to CDs, to bonds, that's much closer to where they are on the risk and return spectrum. However, here's the other thing that many people don't know. There are lots of things in between CDs, bonds, or annuities. So that's what we want to spend a little bit more time on today talking about, because many people simply don't know what's out there. They think their choices for conservative investments are either cash, CDs, bonds, or fixed annuities. But in reality, there are several other choices that are available today as well. One of the things that's really been growing in the investment space is this thing called an interval fund, which on the surface looks like any other mutual fund, except the word interval means it's not liquid every day. You can't sell it anytime you want. Typically, it's available to be sold once a quarter. But even there, and looking at the fine print, it's once a quarter, but typically limited to 5% of the total fund. So while the idea may be you should be able to sell it every quarter, if everybody tries to sell it at once, the fund may step in and say, we can't actually honor all the distributions at once. We may be able to only honor 20%, 50%, 80%. So it's important to understand, if you're looking at interval funds, one of the benefits, they're typically less volatile. We can look at times when the market has gone down, whether it be a month or a year. They typically have not gone down to the same extent because they're not traded every day. But the trade-off with that is you are giving up liquidity, and while in theory it should be 100% liquid every quarter, that's not always the case. So you do need to have an understanding, or at least look at the history of that fund to understand, is that an appropriate investment for you? How many times have they limited an investor's ability to get all the money out if they wanted to? But from a risk-return point of view, they do have some attractive returns at relatively low volatility, provided that fits with your overall investment strategy. Another strategy that has been evolving came from the annuity world, but has now been adopted by index funds and ETFs, is what is called the buffered ETF. And what that means, it sounds a lot like an annuity. It's an index fund that is liquid every day. It generally tracks one of the major indexes: S&P, the Dow, the NASDAQ, maybe the Russell 2000 for small cap. Just like the name implies, there's a buffer or some level of protection against loss, should that index or fund begin to go down. Typically, you can get those with a 10% protection, a 15%, perhaps even 20%. So hopefully, with today's video, you're aware that there are things when you're looking for more conservative pieces of your portfolio, there are choices beyond simply CDs, annuities, bonds, and cash. So things such as interval funds, buffered ETFs, or fixed index annuities may be an appropriate choice for some portion of your portfolio. What we always recommend, though, is to have a plan for your overall retirement. So in today's video, hopefully we gave you a little bit more information about what's out there. If you have questions on whether investments like this may be a good fit for you or a good fit for a portion of your portfolio, and you want additional information about topics such as this when it comes to your retirement, make sure you subscribe to our channel. Or better yet, if you have individual questions, feel free to reach out to us at info@outlookwealth.com.